Now, the last main topic we're going to be going over is the ratio analysis. The ratio analysis is going to be probably the more difficult part of this chapter because there's a lot of formulas for us to go over. So this is where the building blocks from earlier comes into play. We have the liquidity and efficiency ratios, and I'll be going over all of these separately coming up. So we have, current ratio, acid test ratio, accounts receivable turnover, total asset turnover, days sales and inventory, days sales uncollected, and inventory turnover. So there's a lot of formulas here. Solvency, not as many. So the solvency ratios are the debt to equity ratio and times interest earned. We have the profitability ratios, profit margin, return on common stockholders' equity, and return on total assets. And then market prospects, earnings per share, price to earnings ratio, and dividend yield. So like I said, we're going to be going over all of these separately. So first we'll be going over the liquidity and efficiency ratios. Okay, so the first one we have is the current ratio. And by the way, liquidity and efficiency ratios are how easily can the company turn what it has into cash? Are they taking our cash and using it efficiently? Okay, so for the current ratio, it measures the short-term debt-paying ability of a company. A higher current ratio suggests a strong liquidity position. So for this one here, we want a higher number. The higher, the better. Basically, can our current assets cover our current debt, our current liabilities? And we definitely want it to. We want at least an answer here of 1 because we do want our assets to cover our liabilities. But like I said, the higher number, the better. So when we do this formula here, we want to make sure we take just the current assets. So this is a common mistake. It's not all of your assets, just the current ones. Divide by just your current liabilities. So the better you are at understanding the balance sheet here, the better you'll be able to do this by being able to figure out which ones are current and which ones are not current, the long-term ones. So you do have to separate that out. Next, we have the acid test ratio. This is a really strange name for it. It's also called quick ratio. So it's very similar to the current ratio, but basically we just take a few things out of it. Analysts say that some of our current assets we do need or it can turn into cash as quickly as some other things like inventory. Maybe we can't sell it as quick. So we want a much quicker ratio here. So we just take our cash plus our short-term investments plus the current receivables. So it's not all of our current assets, not like we won't include our inventory or prepaid expenses, but we will be taking a lot of our assets here, current assets, just not all of them. And we're just going to divide by current liabilities, so it'd be the same thing you had for the current ratio. You would use that same number here for current liabilities. Okay, and then we have the total asset turnover. So as it states here, reflects a company's ability to use its assets to generate sales as an important indication of operating efficiency. So once again, we want a higher number, and same thing with the acid test ratio, a higher number, the better. So total asset turnover, it would be net sales, so your sales divided by your average total assets. So we're doing an average here, so don't just look at what our total assets are. You're going to look at your total assets from this year, last year, add them together, and divide by 2. So it's really important when you see average here that you have to calculate the average from last year to this year. Okay, we're going to go over some more of these liquidity and efficiency ratios. So we have accounts receivable turnover. Measures how many times a company converts its receivables into cash each year. We do want a higher number. We want it to turn over as many times as we can, which means that we're making sales and we're collecting the money. We want to keep doing that many times throughout the year. So to do this, we want net sales divided by average accounts receivable. Remember, here's that word average again. We're going to take our accounts receivable from this year and last year, add them up, and then divide by 2. Next, we have days sales uncollected. So it's really similar to the accounts receivable turnover. It's almost like backwards a little bit. This is how many days that we have an account on our books. Somebody owes us money before we collect it. So it's the average amount of days that someone owes us money. And in this case, we want a lower number. I mean, ideally, we want somebody to owe us money for maybe 1 day and then pay us. If it's over maybe 60 days, there's a problem. We're not collecting money in time. If people owe us money and they're supposed to pay us within 30 days, then we always want this number to be under 30. So to do this, we do our net accounts receivable, divide by our net sales, times 365. Okay, next we have the inventory turnover. Similar to the accounts receivable turnover, it's how many times a year our inventory turns over, so that we buy the inventory, we sell it, and replace it throughout the year. We want a higher number here. We want it to turn over as many times. We want to buy inventory, sell it, do it again. Buy inventory, sell, and we want to keep going through this same system. So you would be doing cost of goods sold divided by average inventory. Remember, it's the average. So we take inventory from last year, this year, add it together, and divide by 2. Okay, days sales and inventory is similar to days sales uncollected here. So it's how many days we have our inventory for before we sell it. We want a lower number because ideally we only want our inventory for a short amount of time as possible before we end up selling it. Now this would be different depending on what industry we're in. So for instance, a restaurant that has fresh food, they might want a much lower number, like maybe under 7 days before they end up selling it. A company that, like a car dealership, it might take them 60, 90 days to sell a car, so they'd have a much higher number. So it really depends on the industry here. But you would be taking your ending inventory, so basically this year's inventory, divide by your cost of goods sold, times 365. Okay, so now we're going to start talking about the solvency ratios. So solvency really means the survivability of a company. Can they survive over time? Are they solvent? Are they going to be able to pay a lot of their debt? So first we have the debt to equity ratio. It measures what portion of a company's assets are contributed by creditors. A larger debt to equity ratio implies less opportunity to expand. So in this case, we do want a lower number. This one's pretty easy. It's just your total liabilities over your total equity. Okay, times interest earned. This is the most common measure of the ability of a company's operations to provide protection to long-term creditors. So basically, out of the income we're making, can we pay our interest expense? Because we do owe that to the people we borrowed money from. So can we pay our interest? And we want a higher number here. We want to be able to pay our interest many, many times. Definitely something higher than 1 we want to get, and the higher the better. This one here is a little harder to do. It's income before interest and taxes. So basically it's our income, our net income, and we want to add back our interest expense and our tax expense. So our income right now already has interest and taxes taken out of it. So that's why we want to add it back in. And then you would just divide by your interest expense. Okay, we have the profitability ratio. So these are basically how profitable a company is doing. Lets us know, if we're doing well with our sales and with our income. So the first one is profit margin, describes a company's ability to earn net income from each sales of dollar. So basically here, it's really easy. It's your net income divided by your net sales. So basically out of all the sales I made, what percentage of that will go to my net income? Like, what do I get to keep after I pay all my expenses? So we definitely want a higher number here for profit margin. The higher, the better. Ideally, we want to make sales and keep all of it, but we can't do that. We do have to pay salaries, maybe office space. So a lot of our money does need to go somewhere, but we want to keep as much as that as we can. Okay, return on total assets measures how well assets have been employed by the company's management. Or are we using our assets effectively? Are we taking our assets and using them to make income off of? Just like OCC's asset of the Gateway building, are we making money off of it? Yes, because there's classes there. So this kind of just lets us know if we are using our assets wisely, and we do want a higher number here. Okay, and this one's pretty easy. Net income divided by average total assets. So I'm going to look at my total assets from last year, total assets from this year, add them together, divide by 2, because remember we're doing the average. Okay, Return on common stockholders' equity. This one here is a little bit more difficult as well. It indicates how well a company employed the stockholders' equity to earn net income. So kind of similar to return on total assets. Are we earning income from our assets here? Are we earning income from, issuing stock? So we have net income minus preferred dividends. If a company does not have any preferred stock or preferred dividends, you just wouldn't do anything. It would just be net income divided by average common stockholders' equity. So we have to look at stockholders' equity section, which would be the common stock, the retained earnings. We add that together for 1 year. We do the same thing for the year before. We find the average by adding them together and dividing by 2. Okay, so next we have market prospects. So this is really how well companies are doing in the stock market. So first we have earnings per share. This is a pretty important indicator of how a company is doing. A lot of people in finance really like to know what the earnings per share is. They also call it EPS. So it's the portion of the company's distributable profit allocated to each outstanding share. A very good indicator of the profitability of any organization, and is one of the most widely used measures of profitability. Like I said, it's a very important number. We want the higher, the better. A lot of people in finance won't invest in a company unless earnings per share is over a certain dollar amount. So this is definitely one of the more important formulas that we're going to be doing. So the numerator is really similar to the last one we did, net income minus preferred dividends. Remember, if there are no preferred dividends or preferred stock, you would just not do anything here. Divided by the weighted average common shares outstanding. And I'm just going to give you that number because that's more of a finance thing on how to figure out the weighted average shares outstanding. So I'll just tell you what the shares outstanding are, and you would just use that. But you would get a dollar amount here for earnings per share. So, $2, $5, you do want something in the positive though. Okay, price to earnings ratio, often used by investors as a general guideline in gauging stock values. Generally, the higher the price to earnings ratio, the more opportunity a company has for growth. So you want a higher number here. You would take the market price per common share, so whatever the stock is going for in the market, and divide it by earnings per share, the EPS. So you do have to do earnings per share before you do the price to earnings ratio. Okay, and then dividend yield, this is something we've gone over before. For every dollar invested, what percent do I get back as a dividend as an investor? But you would divide your annual cash dividend per share, divide by your market price per share. So it's pretty easy to do.